Hello there, Wealth Press subscribers. Welcome to another Friday here, and I'm going to wrap the week with Roger Scott. As per usual, Roger, welcome.
Thank you, James. Pleasure to be here, and thank you for having me.
Of course. It has been a rather, indecisive week, I would say. But for the daily record increases in infection rates, which has yet to really manifest itself as a major influence on the market, which seems to be operating in a bubble of its own lately. But what are you seeing happening, Roger? It seems like more or less what you said was going to happen has now happened.
Well, that and more, and there's a lot of things making me very, very nervous. And I'm going to tell you, I don't really have, as a trader, I don't really have any type of analysis bias. I'm the kind of guy where, as long as it gets me where I need to go, I don't care if I got it fundamentally, if I got it technically. I always tend to back into some, but right now, the last month, I would have to say, if you're a technical trader versus a fundamental trader, you would get a lot more clues out of the market. And I'm going to say that very confidently. And I can't always say that confidently, but right now I can. James, there's just so many things that are giving me a bad taste in my mouth. And I want to talk to you about it, even more so than I've talked about the last few weeks. We are now seeing narrowing of momentum, and we are seeing divergence exactly the same kind we had in February. Let me explain that. This is really important. I'd like to explain it to our readers, okay?
Sure.
So imagine you're driving, I'll make this really simple. Imagine you're driving an 8-cylinder car, an 8-cylinder American Ford or a Chevy, 350, regular 8-cylinder engine, and you're driving 50 miles per hour consistently. You're always at 50 miles per hour. And imagine while you're driving that car at 50 miles per hour, someone comes and breaks half of that engine. So the engine becomes a 4-cylinder engine. 4 of the gaskets get taken out, okay? The engine, but you're still driving at 50 miles per hour. Now, you don't know anything because you're still driving 50 miles per hour, but the engine is now working twice as hard, right? To generate the same amount of energy, correct? Horsepower, so to speak. James, we are seeing exactly the same thing right now in the broad market, and more so in the sector that's heating up the most, which is technology. We are still seeing NASDAQ 100 climb up, but momentum levels are declining, which means this means something very important, that less stocks are causing the market to go higher and higher and higher. So imagine you've got 8 horses pulling you. Now you've got 4 horses pulling you, but you're still seeing that same rise in momentum. That's a very, very dangerous precursor to a shakeout.
Sure. Those 4 horses are going to need a lot more rest and fuel before they can carry on any further after a short while.
Yeah, that rubber band got stretched out, and it just keeps trying to stretch out further and further, but there's just nowhere for it to go. That's number one. And this is, look, this isn't something I'm thinking. This is mathematical. I could show this in a complete mathematical sense. I could prove this. Sure, this isn't like a theory I'm having.
Right. Just for clarity's sake, you're not talking about liquidity levels. You're talking about the number of stocks that have momentum to the upside.
That's exactly right. I'm talking about the number of stocks moving higher is going down, but the price on the NASDAQ is still moving higher. You have less stocks pushing it higher. And this is, again, this isn't a theory. We could see this. We could literally see the number of stocks moving higher in the NASDAQ 100 every day. The number is moving lower, all right? We went from 95 to about 80, and now we're moving lower. But the NASDAQ, while we've been doing that, has still been going higher. And that's telling me that smaller percentage of stocks with larger market capitalization are causing the market to rally. And that's very misleading, because ultimately, those 2 or 3 or 4 or 5 stocks, they can try to do what they're going to do, but ultimately the broad market's going to gain control. the example I love to give is somebody walking, a person walking an unruly dog on a leash. That dog is going to do its thing, but ultimately the owner's going to gain control of the dog back. And that's what we're seeing right now. We're seeing that unruly dog just going crazy. But that's just one indication. There's confirmation of this. We're seeing divergence in momentum. What is divergence of momentum? It's when price again continues moving higher, like just like the first example I gave you. But RSI, my momentum levels are moving lower. In other words, they can't sustain higher highs like the price is. So they're high, and these are very, very. I don't use oscillators like stochastics. I use like a 10-day RSI. You can't, most oscillators you can do this, and they'll move.
Right.
Not the one I'm using. I'm using the real deal. I'm using a 10-day RSI. This thing is like a tank. Okay, so I'm using real oscillators, and divergence in between the oscillator and momentum levels exactly looks identical to what we saw in February. Identical. Narrowing of momentum, identical to what we saw in February. Add to that what's going on right now with President Trump. As you know, the Supreme Court came out. They're going to release his income tax. We've got the election cycle coming up. We're way deep into summer. Things are just, everything to me is setting up from a technical perspective like we're about to have another nice little cool-off period. Not necessarily saying it's going to be with as much panic because there's much more known right now. But we're about to get into right now, Monday, the next trading day after today, Monday, earnings officially comes out. And this is supposed to be the trout. This is supposed to be the worst period. If we find out right now, looking forward, and everybody has to come out with forward-looking statements. They can't cheat us 2 quarters in a row. Last time, we understand, we're in the biggest down cycle, but now you've had 4 months. If those forward-looking statements start sounding again like they did last quarter, and we're stretched out, this market is not anticipating it, and it's not pricing it in. And then the fundamentals will catch up with my technicals. Mm-hmm. That's my opinion. But I'm telling you right now, gold is making a multi-year high. Interest rates are treading higher. The S&P 500 is undoing a lot of what it did last week, which was a fragmented week, and it's been very persistently trading around the 200-day moving average. It has not made new high. And now the only sector that's been seeing a lot of flow of money is seeing narrowing of momentum, divergence, and an overall record momentum levels that need to cool off. I can't use words like certainty, but I'm going to tell you everything that I look at is pointing to a cool off in the stock market. Everything.
Okay, that's interesting, Roger, because historically, and this is anything but a historical, year, it's an extraordinary year. It's historical in that sense, but in the summer times we expect an incremental decrease in liquidity and subsequent momentum in certain stocks. But from what you're saying, all these indicators are indicating that we are indeed in danger of a full-scale retreat ahead of the fall, which is when all of the traders come back to work and typically look back on the market's performance in the summer and sort of allocate capital accordingly. So it sounds like, the next few months are going to be rough, but we can't expect much from earnings, but we've also got, the September, the third quarter start. That's going to be, sounds like very scary.
Well, I want to make sure that we're saying the same thing. And there's one thing that I just want to make sure we're on the same page. Typically, what you just said is exactly 100% right in terms of liquidity. Okay. Everyone knows people take vacation summer, people go off, liquidity slows down. It's natural, especially the months we're getting into right now. Second half of July, August, and then beginning of September, or usually most September. But here's the wrinkle here. If you look at election cycles, it doesn't work that way. It works that way every time except for election cycles. In election cycles, instead of cooling off, the summers tend to be fairly volatile or normal, not extra volatile, but the volatility, liquidity doesn't seem to move off. And then right around the end of September, you get a complete dead market around October, end of September, October, leading into the election. So that whole summer low liquidity period is moved about 2 months forward, 2.5 months forward, because of the election cycle. That's what we have seen the last 20 years, including the last presidential cycle. We had very, very active summer. And then instead of the summer dying out, we see a massive slowdown around September-ish, October-ish, right? And then it picks up right after the election. So usually you're 100% on the level, but I've seen a major difference in the election years with that.
Okay, and so I guess this year, election cycle combined with a pandemic that seems to be doubling down really causes all the alarm bells to go off. So what's the strategy here? What's the strategy for investors going forward into this cycle?
I'm glad you asked. And this is something that Jeff Zenaneri and I were talking about on Wednesday. Lower volatility. Volatility right now. Look, VIX, the S&P 500 fear level is at 30 right now. Okay, 33 to be exact this morning. If you looked at it over the last 10 years, the average is about 12. Okay, historically, before this COVID-19 started, if you were to ask me, Roger, when do you start getting panicky about the VIX? I would always tell you, rule of thumb is when VIX goes above 20, that's danger zone. When it goes above 30, traders are in panic zone. And it also means volatility. Option premiums are 3 times their regular size because volatility is 3 times its average. Okay. So volatility in February, for the first time in history, and I don't say that very lightly, went up to the highest level ever. We thought it would peak out at 60. It went all the way to 80. I don't think that was even imaginable. Okay. Well, ever since then, it's been coming down, but it's stuck at 30. It never went below 30. So when you're comparing volatility to where we were in February, you're saying, 80, 30, that's terrific. It's just but when you look at it when you step back and look at it, hey, from a year ago, 6 months ago, 9 months ago, 2 years ago, 5 years ago, it's 3 times higher. So when you're looking at everything in light of the COVID-19, you're thinking, oh, markets are great and they're calm and quiet and they're not really doing anything. But if you look at the broader picture, markets are still, excuse my French, scared. There's just no other way to say it. So we kind of have to take what we're seeing with a big grain of salt and understand that markets are really stressed out still a lot. Mm-hmm. And then when you take into account everything that I said the first 10 minutes of our discussion, add that to the mix, it's really looking a little, and I'm going to tell you, James, I'm not a real bearish guy. I'm pretty bullish most of the time. I'm not one of those guys that sings doom and gloom all the time. Really, that's just not me. So right. The fact that I'm saying this is really meaningful because I usually don't say things like this a lot.
Sure. Okay. Yeah. And so it sounds to me like you're suggesting that the stocks are really not the place to be going forward, and maybe defensive plays like gold and precious metals are the place to be.
That and now I'm going to answer the question, lower your exposure, folks. You should be trading a third of your position right now, maybe half, but no more than that. I think ultimately we don't have a crystal ball. So I think right now what we need to do is we need to, number one, become more defensive, increase your exposure to gold and interest rates. All right. And again, if you're going to trade, if you're a 100 lot trader, trade 50 shares. If you trade 1,000 shares, trade 400 shares. Reduce your position anywhere from half to a third. Trust me, you will still get the same bang for the buck because the volatility is so much higher right now. If we were to look at the S&P volatility, it's about 2.5 times higher than it was historically, 2.5 to 3 times higher, which is why the VIX is 3 times higher right now. It's reflecting that volatility. VIX measures the at the money option premium. It's like a real-time implied volatility indicator. So if you're looking at the VIX, you can always look at the fear level on the S&P 500 in real time. And right now, we're 2.5 to 3 times higher than usual. So increase your defensive exposure, decrease your exposure in technology stocks. Buy stocks that are going to only do better because of COVID-19. Don't try to outguess the market by buying airline or bank or airline bank or cruise ship stocks right now. I'm shorting them again right now. I just went short. We just made 60% on UBS Bank the other day. They're the weakest stocks. Don't try to be a bottom picker. Don't try to think 3 steps ahead right now. Live in today. Be in the present. My philosophy, James, has been pick stocks that were really heating up before COVID-19 struck and are now improving even better because of COVID-19, and then trying to lower my exposure and diversify away from the stock market into gold and foreign markets a little bit. Europe looks like it's picking up. I'm starting to see a little uptick in the euro. Bonds. Try to get away from the U.S. market a little bit, lower your exposure, and find stocks that will only do better. Stay-at-home stocks like Logitech. They make cameras. I'm using a Logitech video camera to talk to you with right now. They're sold out 4 months straight right now. So don't try to second guess when COVID-19 is going to end. Live in that environment and try to prosper from that environment right now. That would be my advice.
Okay. Great advice as usual, Roger. Let's leave it there for now. Come back to you to the roundtable on Monday, and we'll see what the week looks like then. Have a fantastic weekend.
Have a great weekend, and I'll talk to you soon. And thanks for having me on, James. Bye.